Hello everyone. In this lecture of module 4, lecture number 5, we are going to discuss about the numericals related to the profitability ratios. As you have already seen in the last lectures that we have the different types of profitability ratios divided into 3 categories. Now it's time to go for the practical application of all those ratios. To start with, the first problem is, from the following information, you are required to calculate gross profit ratio and operating profit ratio as per the information given. So, starting with the gross profit ratio, which is equal to gross profit upon net revenue from operations. As they are the profitability ratios, so we always calculate it into the percentage. So, we are multiplying it with 100. So, in this question, we are given the cost of goods sold, administration expenses, selling expenses, net revenue from operations. So, for the calculation of gross profit, we will compare the net revenue from operations with that of cost of goods sold as per the statement. We are having net revenue 7 lakh and the cost of goods sold is 5 lakh. So, the gross profit in this question amounting to rupees 2 lakhs. Now, the gross profit ratio is 2 lakh divided by the net revenue, that is equal to 7 lakhs multiplied by 100 comes to 28.57%. And the next ratio we are supposed to compute is the operating profit ratio, which is equal to operating profit upon net revenue from operations computation of operating profit means gross profit, which we just computed amounting to rupees 2 lakh, and out of that gross profit we will deduct the operating expenses, that is administrative expenses and selling expenses. So, out of gross profit we deduct administrative expenses of 50,000 and selling expenses of 60,000. So, the figure we get is going to be rupees 1,10,000 of the expenses and the operating profit will be 90,000. So, the operating profit ratio would be 90,000 divided by 7 lakhs into 100, which comes to the figure of 12.85%. Moving to the next question, from the following information we are required to calculate the gross profit ratio, operating profit ratio and the net profit ratio. So, for the question number 2, starting again with the gross profit ratio, which is equal to gross profit upon net revenue from operations, the whole is to be multiplied by 100. So, the gross profit which is equal to net revenue from operations minus cost of goods sold. Net revenue from the operations as given in the question is 10 lakh rupees and the cost of goods sold is 7 lakh. So the gross profit is rupees 3 lakhs. And the GP ratio or the gross profit ratio will be 3 lakh upon net revenue 10 lakh, it comes to 30%. Moving ahead to operating profit ratio, which is equal to operating profit upon net revenue from operations. So the computation of operating profit is gross profit minus operating expenses. Gross profit we just computed 3 lakh rupees and the operating expenses in this question are 70,000 administrative and selling expenses of 50,000 means 1,20,000. So the operating profit will be 1,80,000 rupees. Now operating profit ratio will be equal to the operating profit 1,80,000 divided by the net revenue from operations that 10 lakh that is given in the question. So it comes to the figure of 18%. Next in the row we have to compute net profit ratio, which is equal to net profit upon net revenue into 100. So the calculation of the net profit will be like this. We have already calculated the operating profit, so we are continuing from the same. Operating profits that we have computed, out of that we deduct the non-operating things like loss on the sale of asset, minus the amount transferred to general reserve, and the third is given in the question is the payment of income tax. So the operating profit in the question was 1,80,000 and the loss on the sale of asset is given 15,000. Amount transferred to general reserve is 25,000 and the income tax paid in the question is given 40,000. So the net profit amounts to rupees 1 lakh. So the net profit ratio will be equal to net profit as just we computed at rupee 1 lakh to be divided by the net revenue from operations of 10 lakh. So it reaches the figure of 10%. Moving ahead to question number 3. Calculate return on shareholders' investment from the following information: equity share capital, preference share capital, reserves and surplus, net profit before interest and taxes, tax rate and the interest charges. So first we talk about the return on shareholders' investment. The formula is return on shareholders' investment is equal to profit available after interest and taxes upon shareholders fund. So first we compute the profit available after interest and taxes. Profit available. As we are given in the question is net profit before interest and taxes is amounting to rupees 2 lakh. First we deduct out of it the amount of interest paid as given in the question 40,000. We get rupees 1,60,000 as the balancing figure. Then out of that we pay taxes at the rate of 50% of 1,60,000 comes to figure of 80,000. So this balancing figure of 80,000 is the profit available after interest and taxes. Now we compute shareholders fund, which is equal to equity share capital plus preference share capital plus any reserve and surplus, as in the given question we have an equity of rupees 3 lakhs, 1 lakh preference share capital plus we are given the reserves and surplus amounting to rupees 50,000. So the total of the shareholder funds comes to rupees 4,50,000. Now we compute return on shareholders investment as per the formula. The profit available after interest and taxes is 80,000 and the total shareholder fund we just calculated 4,50,000. It comes to 17.78%. Moving to the next problem number 4, in which we have to calculate dividend payout ratio with the information provided in the question. So starting with the formula of dividend payout ratio, dividend payout ratio is dividend per equity share divided by earning per share. So first we calculate the earning per share, which is equal to the earnings available for equity shareholders divided by number of equity shares. So this computation of earnings available will be like this. We are given in the question is net profit before interest and taxes which is equal to 2 lakh rupees. Out of that we first deduct the amount of interest charges or the interest paid, which is given in the question 30,000. So the balancing figure of 1,70,000 will be there. Out of this 1,70,000 we are supposed to pay the tax, which is given 50,000 rupees. So we are left with the earnings available for equity shareholders amounting to rupees 1,20,000 after making all the changes into it. But one thing more is given in the question is the preference shares. So out of this 1,20,000, we have to pay the preference dividend to calculate the exclusive amount left for the equity shareholders. So the preference dividend is rupees 10,000. So this 1,10,000 is exclusively available for the equity shareholders. So now we calculate earning per share using this 1,10,000 available for equity shareholders divided by the number of equity shares, which is equal to 3,000, and this earning per share comes to 36.67. Next, we are supposed to calculate dividend payout ratio. Formula we have already mentioned. So the dividend payout ratio is, dividend per share is already given in the question, rupees 20 per share, and earning per share we have just computed 36.67. If we go for it, then we find out that we reaches the figure of 54.54%. It means that almost 46% of the company's earnings are retained by the company for future investment purposes. Moving to question number 5, where again we are supposed to calculate dividend payout ratio, price earning ratio, earnings yield ratio from the information given in the question. So starting with dividend payout ratio, which is equal to dividend per share upon earning per share. So we again calculate in the same fashion as we have calculated in the last, that is the earning per share using the formula earnings available. These earnings are available only to the equity shareholders divided by number of equity shares in a company. So the earnings available to equity in the given question will be the net profit before interest and tax, which is given in the question 2 lakh rupees. Out of this 2 lakh, we first deduct the amount of interest paid, that is 30,000, and then we have given in the question the amount of taxes paid is 60,000. We left with the figure of 1,10,000. Out of this, we first pay dividend to the preference shareholders. So we deduct preference dividend out of 1,10,000. The preference dividend in the question given is 20,000. So this is the 90,000 amount available for equity shareholders. So on this basis, we can calculate EPS, that is earning per share, using 90,000 divided by number of equity shares, which is given in the question is 3,000. It comes to rupees 30 per share. Now the dividend payout ratio will be equal to, as per the question, dividend per share paid is 20 in comparison to the earning per share of 30, which comes to 66.67%. Next in the question, we are to calculate price earning ratio. The price earning ratio is equal to the market price per share with comparison to earning per share into 100. So the market price in the question is 80 rupees. Earning per share we just computed 30 rupees per share. So we reached the figure of 26.67% in the form of price earning ratio. Next in the question is earning yield ratio. Earning yield ratio is equal to earning per share upon market price per share into 100, just the reciprocal of the above. So now it is 30 upon 80 into 100, which comes to 37.5%. Moving to practical problem number 6. The stock of a company is traded in the stock market at rupees 60 per share and the price earning ratio is 6. As we know, the price earning ratio is equal to 6. The price earning ratio's formula is market price per share upon earning per share is equal to 6. As per the question given, the market price is 60 rupees. So the earning per share will comes to rupees 10 per share. And the total income, if we have to compute with the help of this, the net income will come to number of shares into earning per share, as question is talking about 20,000 equity shares. So this 20,000 to be multiplied by 10 comes to rupees 2 lakhs. Next is dividend yield ratio that we have to calculate, which is equal to dividend per share upon market price per share. As given in the question that the company is just paying 75% as the dividend payout ratio. So out of the 2 lakh rupees of the total income, the dividend company is going to pay is just 75% of 2 lakhs, that comes to rupees 1,50,000. Now to calculate the dividend per share, which is equal to dividend paid to the shareholders, that is 1,50,000 divided by number of equity shares, that is of 20,000. So it comes to rupees 7.50. Dividend yield ratio will be equal to dividend per share, just computed 7 rupees and 50 paisa, in comparison to the market price, which is given in the question is rupees 60. So it comes to the figure of 12.5%. And next in the same, we have to compute the return on equity, which would be equal to the net income available after taxes minus preference dividend, and nothing is given in the question regarding the preference shares. So we are just considering the total income as we computed of rupees 2 lakh divided by equity share capital. So the net income we computed in the question was 2 lakh and the equity share given is 20,000. So into 100 it comes to 100%. This is the return calculated for the equity on the book value basis. If we have to calculate the return on equity on the basis of market price, then in that case we will consider the market price per share, which is given 60 in the question. So the total value of equity in that case will become 20,000 multiplied by 60, which comes to rupees 12 lakhs. And now, according to this, the return on equity will be 2 lakh rupees, the return available for equity shareholders to be divided by the total value of equity 12 lakh into 100, which comes to 16.7%. So, with this, we come to an end of the slides relating to the profitability ratios. I think with the help of these practical problems, you will be able to solve the question yourself. Thank you so much for your attention. Thank you so much. Thank you very much.